and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast.
Thanks for bringing me back, Push.
We truly appreciate your time and insights as we explore critical topics shaping the landscape of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely cheques and ACH debits remain most susceptible to payments fraud, 4 ways to help treasurers concentrate cash on a global or regional basis, 2025 to witness improved global economic outlook, and finally, KPMG says global supply chains are still fragile. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com, either by visiting the website or by following the links provided in our show notes. Let's begin today's discussion with our first story, which is about cheques and ACH debits remaining most susceptible to payments fraud. The proliferation of payments and payments innovation has also opened up fresh opportunities for perpetrating payment fraud, resulting in an upswing in fraud attempts last year. Examining the payments fraud landscape in 2023, we see an uptake in fraud activity from the previous year, with 80% of organizations reporting they were a victim of an attempted or actual fraud attack, as per the Association for Financial Professionals, or AFP's 2024 Payments Fraud and Control Survey report, sponsored by Truist. The AFP survey polled over 500 treasury practitioners from organizations of varying sizes and operating across a broad range of industries. The findings of the 2024 AFP Payments Fraud and Control Survey report show that despite heightened awareness at organizations about payment fraud and the controls and processes put in place to safeguard organizations' payment systems and minimize instances of fraud, it is clear that perpetrators of fraud are relentless. They are continuously devising ways to infiltrate payment systems at organizations. The survey delves into the nature and magnitude of fraud attacks directed at business-to-business transactions, including the impacted payment methods. Among the key takeaways of AFP's 2024 Payments Fraud and Control Survey report is the findings that cheque and ACH debits remain the most vulnerable to payments fraud. Cheques and ACH debits were the payment methods that bore the brunt of fraud activity in 2023, accounting for 65% and 33% of impacts respectively. According to the AFP study, the fact that cheque fraud remains the most prevalent form of payments fraud is not surprising. Cheques continue to be the payment method most often used by organizations. The percentage of respondents indicating instances of fraud through ACH debits grew from 30% in 2022 to 33% in 2023, potentially linked to the rise in cheque fraud occurrences. Criminals are generating ACH debits using stolen cheque information. Paul, payment fraud is on the rise, and with 70% of organizations using cheques having no plans to discontinue their use over the next 2 years, as indicated by the AFP survey, cheques and ACH debits are likely to remain the 2 payment methods most susceptible to fraud. In such a scenario, do you think the vulnerability of cheques to payments fraud underscores the importance of corporate treasurers to phase out their usage and adopt alternative and safer payment methods? Also, can you suggest a key payment fraud control measure to safeguard against cheque fraud and ACH debit fraud?
Yeah, Push. I think what I'd like to start out with is fraud pays, and that's why we see that there continues to be an increase in people out there willing to take a career in being a fraudster and stealing money. And it does pay. And we can see it in the numbers. These numbers, are significantly large in terms of the attacks. There are a lot of successes. And I think we have some challenges to organizations moving away from checks. And I say this because I really believe that we're talking about generational changes. And older generations are used to having paper checks in their hands, and they still like that. And we still have plenty of boomers that are alive today that, that's where they gravitate towards. I can remember early on in my career when I managed a teller line at a bank, and when they would get their Social Security checks, we would have long lines of elderly people come to the bank to cash their checks. And I think there's still a facet of people that's what they do. They get that paper instrument and they go to the bank and they cash it or they deposit it. Some people just don't trust electronic financial institutions, so they'd rather pay with cash anywhere that they can. And in terms of paying, utility bills and otherwise, they write checks. It's still very prevalent. How do you move away from that? I think it's generational. I think as we have our citizens age, we'll start to see that pare down over time. The acceptance of using electronic payments is more amenable to younger generations. They're willing to accept that. Now, both as you pointed out, check fraud, ACH fraud, very prevalent. How do you protect against that? Banks today offer services, positive pay being one of them, the other being even better, pay positive pay, which not only does it match amounts, check numbers, it matches who it's going to. That's an extra step that will help ensure that the fraud doesn't go through. It helps protect companies. So I think as a treasurer, I need to make sure I have the right banking services in place to protect myself. And what does that mean longer term in terms of fraud writ large? It's great we have these tools. What's going to happen is we're going to see fraudsters evolve, and they're going to attack in different ways. They're going to find ways around these barriers to stealing money from organizations and individuals. They'll find ways to do it. It doesn't mean that we sit back and not prepare ourselves for that. As a treasurer, we need to make sure we're protecting the treasure. We need to have the right services, controls, systems in place to eliminate a chance that something's going to happen. And when we talk about systems, we're talking about use of your treasury management systems, your reconciliation systems. Organizations should be reconciling daily. That's how you're going to catch a lot of fraud, just in reconciliation. So, organizations that aren't doing some of these things in terms of bank services that have controls, or the controls and systems, they're hurting themselves by not putting these things in place. So I think it's imperative that treasurers keep up to date on what the fraudsters are doing and what the technology and services are offering to protect them from the fraudsters getting a hold of the treasure that they're in charge of. Being the superintendent of payments, they're superintendent of payment security as well. So they need to keep that front of mind and stay on top of it.
Stay on top of that. Thank you, Paul. You made some great recommendations. Let's shift the discussion to the second topic, which pertains to cash concentration. More specifically, 4 ways to help corporate treasurers concentrate cash on a global or regional basis. Cash concentration involves the transfer of all funds or pooling of cash funds from different bank accounts across an organization into a single account, usually at the end of the day and in some cases on an intra-day basis. Concentrating cash held in bank accounts in diverse jurisdictions and regions can be daunting, especially when overseeing operations across multiple time zones during times of economic uncertainty. Nevertheless, numerous companies are able to concentrate the major international currencies both on regional and global scale. For instance, a large multinational with a presence in over 100 countries might have a series of cash pools, one in Singapore, another in Europe, and a third in the US, with each one focused on pooling only US dollar denominated cash, according to the Association for Financial Professionals or AFP's 2024 Executive Guide, Concentrating Cash Across Borders, sponsored by Standard Chartered. Yet, despite the availability of cash pooling solutions, it can be very difficult for companies to concentrate all their cash on a regional or global basis, even if they chose a location for their header account that has few regulatory restrictions, such as the Netherlands or Singapore. There are multiple reasons for this, both regulatory and practical, the guide adds. The AFP Executive Guide recommends 4 ways to help corporate treasurers concentrate their cash on a global or regional basis. These are: first, build a governance structure; second, choose the right banking partner or partners; third, leverage technology to enable real time reporting and record keeping; and lastly, measure the efficiency of the cash concentration structure. Paul, given your diverse treasury advisory experience, can you shed light on what you would consider as the two most important ways corporate treasurers can concentrate their cash globally or regionally?
Yeah, Push, I like this article because it breaks it out into components that are easy to understand and important. Obviously, regulatory constraints on a global basis are a challenge for an organization that has a footprint that goes out beyond its existing borders for, let's say, the US, if it's a US based company. Having that global footprint presents challenges for pooling cash, for sure. Doesn't mean that you don't take advantage of it. And I think the way that comes is two-part. One is through technology, the use of technology. Treasury management systems offer modules within there that help you manage pools. Pools of cash. It can either be cash concentration or it can be notional pooling. And so you can net things out at the end of the day with a central pool of cash, be able to facilitate payments across the various organizations and on a global basis. So cash pooling becomes really important. The other piece is your banks. Your banks offer you products and services that will help you with pooling of cash, whether it's overnight investments or the facilitation of cash through the account structure. So whether you have a header account, concentration account, or other accounts that help you pool cash with it at your bank can help you do that. And obviously managing FX can be a challenge. In today's world, US dollar continues to be the reserve currency. And so the good thing is that you have a currency that you can pool globally into a single currency denomination. Obviously, you would want to have the right risk management components tied to your FX pool. But just thinking about from a pool itself, these structures, the bank structures, the products allow you to do that. And I think the last mention in here was around choosing the right banking partner. I think that is really important. So when treasurers think about the relationships that they have with banks, it's not just banks tied to the work that the Treasury team does. It's across the entire organization. It's how you fund capital management, not only your liquidity, but your capital management. How do you get the right products and services to drive your business? And for a lot of organizations, it's investments, it's hedging, it's risk management, it's the cash pooling that we're talking about here, it's the banking services. The share of wallet is really important. Some banking partners are better at certain things than others, and so you have reason to not just concentrate with one partner, but across a pool of partners that are effective in key areas, products, services, as well as locations on a global footprint.
Well, Paul, your discerning perspective about cash concentration on a global or regional basis are greatly appreciated. Next up, let's delve into the third story, which is about 2025 likely to witness an improved global economic outlook. Standard Chartered now expects global GDP growth of 3.1% this year, unchanged from 2023, and 3.2% in 2025, an improvement from earlier forecasts of 2.9% and 3.1%. According to the bank's Global Focus Economic Outlook, Quarter 2 of 2024, which covers the outlook for 58 economies, key geopolitical issues, and financial market implications this year and beyond, Asia is set to remain the primary engine of global growth. Paul, I'd like you to wear your corporate treasury hat and your economist hat, if you may. And from both those perspectives, do you concur with Standard Chartered's improved global economic outlook for 2025?
Yeah, Push, I think I got maybe a little bit different take than what they have here. I think there's some headwinds and challenges. It doesn't mean that we can't get to an improved global footprint, but we do have some significant challenges ahead of us. And I'll address several of them. One is the continued increase in global conflict. The Middle East is a hot spot. Ukraine is still going on. That's disrupted supply chains along the way. It's harmed relationships globally as well. And I think, those things just will continue to present challenges or risks to the global economy in terms of whether they expand or turn into something more or not. We don't know, but the risk is there. And so I'm focused more on the potential risk that is at play. What else I think is going on out there is the U.S. is still a significant driver of the global economy. And right now we have an extremely strong dollar. Asian currencies have just been getting beat up. And so that is not a good thing for Asia in that scenario. And while China is exporting deflation, it's at a decreased rate. They've even come down quite a bit in terms of their GDP expectations. And we don't know where they're actually going to land. They may not land there. They could be short of that. If the disflation or disinflationary export from China was significantly more, then I think an uptick for 2025 would be there. We still don't know what the Fed's going to do here in the U.S. There's still a potential that they don't cut at all. As a matter of fact, I believe there's a potential that they could increase rates. It all depends on some of the key factors that we see. What's going to happen with jobs? What's going to happen with inflation? Is the economy actually going to slow down? Are we going to see some things that we really don't want to see, which is pain? People get laid off. People aren't making their debt payments, their credit card payments. The thing that drives the U.S. economy is the consumer, right? The consumer has a big impact. Consumer could be hurting the second half of this year going into 2025. If the U.S. slips into a recession, I think that presents some challenges for the global economy. So I'm not as rosy as Standard Charter is. I would say I am optimistic that we have opportunity for upside, but I do see some definite risks out there that could either push the global economy down, or if they don't come to fruition, could help support growth in 2025.
Well, that's an insightful viewpoint you shared, Paul. From the global economic outlook, let's move to the fourth news story, which is about global supply chains. I know you just touched upon global supply chain. So supply chain stability saw tremendous improvement in 2023, but several variables are still driving continued fragility, with little or no prospect of nearing a return to pre-pandemic normality over the next 12 months, reports KPMG. The annual KPMG Supply Chain Stability Index, or SCSI, is produced by the Big Four accountancy firm in collaboration with the Chicago-based Association for Supply Chain Management. It aims to help supply chain professionals understand the stability of U.S. operations. Authors of the SCSI report that 2023 saw tremendous improvement in increased supply chain stability overall, but adds that several variables are still driving continued fragility. Paul, several factors, some of which you have enumerated a few minutes ago, are adding to the fragility of global supply chains. While supply chain challenges persist, do you think there are some reasons to remain positive about global supply chains in 2024 and beyond?
Well, Push, I'm probably a little more pessimistic in terms of what we're seeing out there, but it just, goes back to what I was talking about earlier. Do some of these risks come to fruition? Do we have a broader conflict in the Middle East? Iran and Israel trading bombs is not a good thing. Does that escalate? We certainly don't want to see that in the Middle East. That means supply chain through the Red Sea is probably going to come to a halt. We've seen what's happened in terms of what's going on in Ukraine. There continues to be challenges there. Ukraine supplies a lot of food to countries around the region there. I think that those supply chains can be strained. We have constrained relationships with China, and China continues to be more emboldened in terms of what they consider to be their territory, and the issue with Taiwan still exists. So taking control of the creation or the building of semiconductors is, I think, an initiative for China. Taking that over would be a challenge from a supply chain standpoint. Then we look at what's going on in the border here in the U.S., between U.S. and Mexico. That is also a challenge that we have right now. So I think there's definitely some things that are risks to continued instability of the supply chain. One of the things, though, that I think are coming out of COVID, Ukraine, the Middle East, what's going on the border, is companies are realizing they can't have all their eggs in one basket in terms of where supply is coming from. And so the positive thing that's come out of all this is, at least from my standpoint, if I'm thinking about supply chain, is onshoring, nearshoring, friendshoring. These options are more prevalent. Companies are realizing they can't be totally reliant on one place because the global economy doesn't operate at the same pace. Geopolitical things come into play, conflicts come into play. There's a lot of different factors that come into play. So with the advent of these three areas, onshoring, nearshoring, friendshoring, I think that actually provides more stability to supply chain. So it could offset these risks and some of the things that are challenges today. And, they're already figuring out different ways to move things around. So I think, stability overall will be better in the long run as organizations move this direction.
Well, onshoring, nearshoring, friendshoring, well, you made some compelling observations, Paul. Finally, what is your choice for the biggest or most important story of the past week and why?
Yeah, Push, this is going to be kind of twofold, and I'll tie them together. One is the Fed coming out and saying that they don't see dropping interest rates in the near term. That's obviously significant. You've seen an uptick or a bump in a potential rate increase. It's still not the majority by any means in terms of probability, but the probability's increased. The other thing that we've seen out there is IMF came out recently, it was within the last week, had said that the U.S. and China debt poses, significant risk to the global economy. So I think these two things combined, and when you talk about U.S. and China, the two behemoths out there when it comes to the global economy, I think, this is something that people need to pay attention to. And I think both countries respectively need to step back and take a closer look at how they're funding things. We can't just continue to move at the pace we're moving. It's not good for us, it's not good for others, and at some point you can't ignore it. You need to address it. So I think countries that have these challenges step back, focus on what needs to be done to get things moving in the right direction, I think is going to be most beneficial to our global economy.
Well, that's great advice. We've come to the end of this podcast episode, Paul, and I'd like to convey my huge thank you to you for your detailed and informative analysis. We would also like to express our deep gratitude to our CTM File audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.